Hi everybody, this is part 2 on the topic of lease liability paid off using convertible debentures. As I said in my previous video, this is a very interesting topic that combines elements of IFRS 16 on leases and IFRS 9 on financial instruments. It is in response to a query that was asked by one of the viewers. In this video, I will be solving a question that will illustrate to you how to account for this particular scenario. Now, before you go into this video, it is very important that you already know how to account for a lease in the books of a lessee as well as relevant topics under IFRS 9. I have prepared videos on this. I'll share the links over here. Please do go through them, especially part 1 on this topic. Please note that whenever I refer to IFRS 16 and IFRS 9, it is equally applicable to IND AS 116 and IND AS 109. Now, a quick recap before we go into actual solution of the problem. The steps that I will be using to solve this question are: first, I will recognize the lease liability. Second, on the date of issue of the new debt, I will assess the qualitative and quantitative criteria on derecognition of an existing liability. As the new debt is a convertible debenture, I will split that liability into debt and equity components. Now, in the subsequent years, I will measure the debt at amortized cost using the effective interest rate. And finally, on the date of conversion or redemption, I will discharge the financial liability. Alright, so with this, let us start solving the example. The lessee leases an equipment for 5 years on 1st January 2022. He pays $20,000 on the date of commencement. The first annual lease payment of $30,000 is to be paid at the end of the year. Thereafter, there is an increase in the lease payments by 5% every year. The implicit rate in the lease is not available and the incremental borrowing rate is 12%. On 31st December 2023, the lessee does not have sufficient cash to pay the lessor. So he renegotiates the agreement with the lessor. Negotiation fee is $2,000. As per the new agreement, the lessee, instead of annual payments, will issue 1,500 10% convertible debentures at a par value of $100 per debenture to the lessor. The debentures are redeemable at par on 31st December 2028, or these may be converted to equity shares at the face value of $50 in the ratio of 1:2 at the option of the holder. The interest rate for equivalent debentures without conversion right would have been 11%. Show how the entries will be recorded in the books of accounts. Let us start by doing a summary of the important points. First of all, the lessee leases the equipment for 5 years. So our lease term is 5 years. He pays $20,000 on the date of commencement. So that's an advance lease payment, which is $20,000. The first annual lease payment of $30,000 is to be paid at the end of the year. And there is an increase in lease payments by 5% every year. Discounting factor 12%. On 31st 12, 2023, he is renegotiating the agreement with the lessor. The negotiation fee is $2,000. Issues 1,500 10% debentures at the rate of $100. The conversion option that they have given us is 1 equity share for 2 debentures, and the face value of the equity shares is $50. Market interest rate for the debentures is 11%. Journal entries. So let us start. Our first working note is relating to recording the lease. So it is the lease liability. Right. In this note, I have added an additional column for year. So whenever there are changes that happen during the lease term, I prefer to write the actual year. For example, this lease starts in 2022 and goes up to 5 more years. So 2022 to 2026. Please remember the year 2026 because that is when the depreciation on the ROU asset needs to stop. Right. The year in numbers, this is like how we calculate every present value. It depends on the actual timing of the payment. So the first payment that gets made is at the beginning of the year. That's the advance payment, and therefore the year here will be 0. This I've covered in detail in my video on present value. I have given the link here. So over here, this is the advance lease payment, and that amounts to 20,000. The discounting factor, we take the incremental borrowing rate, which is at 12%. How do we calculate this? 1 divided by 1 plus 12% raised to year-end numbers. Counted cash flow is. Now there is also an annual lease payment. The annual lease payment for 2022 happens at the end of the year. That makes this 1. Let's populate it for the different other years. In 2022, the value, as you see, is 30,000, and this increases by 5% every year. The discounting factor formula and the discounted cash flow. Let's pass the entry on the date of commencement, which is 1st January 2022. ROU assets account debit to, there's an advance paid and the remaining lease liability account. ROU assets, it's the total amount, the bank, the advance payment, and the lease liability. Now let's go to working note number 2, closing balance of lease liability. We do not calculate this till 2026 because we know that in 2023 there's going to be a change. So let us calculate it only till the opening balance of 2023. So in 2022, the lease liability is at 118202. There is an interest at the rate of 12%. Repayment. Closing balance is opening balance plus interest minus repayment. 23. We know that it is at the end of 2023 that he runs into cash difficulties and he cannot make the repayment. So the value of the lease liability as on 31st December 2023 includes the interest for 2023 and it is 114672. Let us pass the entries for 2022. The first entry is the interest. The second entry is depreciation, which is equal to the ROU asset divided by 5 years of the original lease term. The next entry is the repayment, which is 30,000. The next is the expensing out of interest and depreciation. Now on 31st December 2023, we will continue to have the entries relating to interest and depreciation. Interest from working note 2. Depreciation, straight line basis, so same as before. And finally, the interest and depreciation for 2023 get expensed out. Now comes the main entry. This is the time when the lessee realizes that they can't pay in cash and they want to issue convertible debentures. Now the first step that we need to do is decide whether we need to de-recognize the lease liability or not. I will do the quantitative assessment for your understanding, but over here it is very clear that a convertible debenture is inherently very different from a lease liability. The main point is that these debentures can be converted into equity, whereas a lease liability cannot. So we definitely must de-recognize the existing liability. But for your understanding, let us do the quantitative assessment anyways. So the working note 3 is the NPV of the new debt. Over here, we need to calculate the net present value of these convertible debentures using the interest rate that we used for the existing liability. So in this case, it is 12%. Right, the first one is the actual years. In 2023, there is no cash flow relating to interest on debentures happening, but there is a negotiation fee of 2,000. That is what needs to be paid in 2023. We are already at 31st December 2023, so the year here is 0. After that, we populate the years. 2023, there is a negotiation fee of 2000. Discounting factor is 1. The next 5 years, we have interest on debentures at 10% multiplied by 1500 debentures at a value of 100 each. So we have 15,000. That stays constant throughout. The discounting factor, the discounted cash flow. Now in the last year, there is also a final redemption. The redemption is at par. So we have 1500 debentures multiplied by 100 face value. The NPV of the new debt using the existing effective interest rate is 141,186. Now this we need to see what is the difference percentage in percentage terms when we compare this with the NPV of the remaining cash flows of the lease liability. This means the closing balance in 2023. So let's calculate the difference percentage. It's 23%. So it does meet the quantitative assessment, which means at this stage itself, we can decide to de-recognize the lease liability. But like I said before, the convertible debentures is so different in its nature from a lease liability that irrespective of whether we do the quantitative assessment or not, we would have been required to de-recognize the lease liability. Now, when we de-recognize the lease liability, the debit is of course to the lease liability. The value we have already calculated over here. The credit, if we look over here, it is a convertible debenture. We have learnt in the earlier video that in case it is a convertible debenture is a compound financial liability which contains both debt and equity elements. What we need to do is split the debt and equity elements. How do we do this? We first find out the value of the debt component. This we do by calculating the net present value of the cash flows relating to the debt, but not using the old interest rate. We use the interest rate that would have applied to these debentures had the conversion option not been there. So that is the market interest rate. Now please note that when we are calculating this value of the debt, we do not include the negotiation fee. So for the quantitative assessment, we did include the negotiation fee, but when we are calculating the fair value of the debt component, we do not include the negotiation fee. So that is our working note for fair value of debt component. So the years are, it starts off with 2024 when we have the first cash flow and it goes on to 2028. The year in numbers. Every year we pay interest on debentures and in the last year there will be an actual redemption. The cash flow is a 10% interest every year with a final redemption. Now here the discounting factor is not the old interest rate but the new interest rate, which is the market interest rate on the debentures is 11%. The discounted cash flow. The value of debt 144,456. Therefore, the value of equity is 1,500 debentures into 100. This is the value of the debt, the debentures. We subtract the debt component and we get an equity of 5,544. Now we pass the entry. Let's leave a line for the difference between the carrying amounts, which we know needs to be expensed out. So we have 10% convertible debentures. The value is 144,456. There is a conversion option which comes under equity. The value is 5,544. We also said that the negotiation fee, it is not included as a part of the debt, but it is taken separately to P&L account. So let's put that in here, which is a value of 2,000. What goes into the P&L account is the difference. So the most important entry in this problem, I hope you have understood this well. Now once we are done with this, then the next step is the subsequent measurement of the debt component. We know that in subsequent years, a financial liability is recorded at amortized cost using the effective interest rate method or fair value. Over here, it is the amortized cost. The effective interest rate is 11%. So let's calculate that. So we have here the interest cost is at 11%. The interest paid is at 10%. And then we have the closing balance. The years first, our balance was 144,456. The interest cost is 11%. The interest paid is 15,000. The balance here is the closing balance plus the interest cost minus the interest paid, and so on for the remaining years. Over here on the last year, you will see that the final value is what will get redeemed. Okay, so now let's pass our usual entries. The first one is interest to bank account. This is the interest paid. Let's take the amounts. The interest expense is 15,890, but what gets paid is only 15,000. So what happens to the 890? Gets added to the convertible debentures. We have the usual depreciation entry. Please note that this depreciation will only be till the end of the original lease term, 5 years, from 2022, which comes to 2026. Then the expensing out of interest and depreciation. Now these very same entries will be passed for 2025, 2026 and 2027. Let's come to 2028 when the actual redemption takes place. First is the interest entry. Let's go to the working note. The interest cost is 16,351, paid 15,000, and the difference goes into the debentures. There is no depreciation because the ROU asset has already been completely depreciated. We expense out the interest cost. Now we come to the actual redemption. What is getting redeemed? The debenture. Let us say that lessor opted to convert into equity shares. You have 10% convertible debentures. The value 150,000. Now it gets converted into equity share capital. The ratio is 1:2. That means 1 equity share for 2 debentures. Which means the number of equity shares is 1,500 divided by 2, and this is at a face value of $50. Where does the remaining go? It is share premium. So please note that if they give you the market value of the equity shares, you do not take that into consideration over here. Over here, the only thing that you need to take into consideration is the difference between the carrying value of the debentures and the face value of the equity shares will go into share premium account. Now, you remember there was a conversion option. The equity part of the compound financial liability of 5,544. It needs to be debited and it can go either into the share premium account or the capital reserve account. So these are the entries that you need to pass for this problem. Okay. Thank you very much for watching this video. I hope you found it very interesting. If you have any problems or queries relating to this video or any of my previous videos, or you have an accounting problem that you think I could solve, please do share it with me and I will try and create a video on that. So thank you very much for watching. I hope you found this video helpful. Bye.